Alright, in this session I want to continue in valuing bonds. Last session we valued a 10-year treasury, and I said what I want to do this time is move to corporates. Before I do that, I want to step back and look at doing an estimate and a shorthand for treasuries, and then we'll do the same thing for corporates. So first of all, the estimate. We came up with a price of 1323.89 by discounting all these cash flows. So we had a bond that, let's say, it was issued 10 years ago, a 20-year bond issued 10 years ago. So its coupon is really high at 5%, but its discount rate's only 1.5%. So the price is going to be greater than $1,000 because you're getting 5% in a market that's only paying 1.5%. And so can we estimate that? So if you remember the formula that said the percentage change in the price of a bond equals minus duration times the change in yields. You need this formula for the first exam, so it's a good chance to review it. So the percentage change in the price of the bond is minus duration times the change in yield. Now when this bond was issued, it was issued at $1,000 with a coupon of 5% because interest rates were 5% back then. So interest rates were 5% then, now they're 1.5%. So all we're missing here is the duration. Well, this is a 10-year bond. I'm going to guess, and we'll see how close I am. I'm going to guess the duration of this bond is about 8.5 years. You'll see on the exam, I always give I give shorter duration problems. Duration will be somewhere around the maturity of the bond. So if a bond has 10 years maturity, duration will be shorter than that, but not radically so. So if the maturity of the bond is 10 years, duration will probably be 8 to 9 years. If maturity of bond is 5 years, the duration will be 4 to 4.5 years. If the maturity of the bond is 2 years, the duration will be pretty close to 2 years. The longer the maturity, the further away duration will be from that maturity. So a 30-year bond might have a duration only of 18, 19 years. So it can vary as you get out there further. But let's just guess that the duration for this bond is 8 years. So we're going to say the percentage change in this bond is minus 8.5 minus duration times the change in yield. Well, the yield today is 1.5%. It was 5%, so interest rates have fallen 3.5%. So we would guess that this bond's price is up 30%. And you can see that the bond's price is actually up 32%. So it gave us a good estimate on the bond. So that's one way you can do it, is get you a quick estimate. How do you actually calculate duration itself? So duration, if you remember, duration is the weighted average time to maturity using discounted cash flows as our weight. So this first cash flow is $24.81 divided by 1323.89. It's that percentage. So to get the duration, we just take the time, which is half a year, times the discounted cash flow divided by the price. Now you don't have to do this on the exam, but if you want to, you can. I might, we're going to see how we're going to do the exam, and I might actually give some students, those that want to, an opportunity to get some extra credit. So if we do that as duration, the duration of this bond is just the sum of the weighted average time to maturity, and I get a duration of 8.29. I guessed 8.5, so I was off a little bit, but it gives you a good estimate of the bond price, how much the change would be. So if you got 30% and your price came out to be $1,100 or $1,500, you would be pretty sure you're wrong. You're going to be somewhere close to that estimate. And that's how you do duration. I'll do it again with do corporate so you can see, even though it's not required for the exam. And then the shorthand formula. So this one, I never get it right the first time. Let's see if I can get it right. But the value of a perpetual annuity, you might have seen this in a previous class, but a perpetual annuity simply equals the cash flow divided by the yield. So let's start off. What would be the value of $25 every 6 months for all of eternity? And the value of that would be the cash flow, $25 divided by the yield. Well, the yield is 1.5%, but this is twice a year, so we have to divide that by 2. So the value of $25 for all of eternity would be $3,333.33. But we're not receiving $25 for all of eternity. So we're receiving $25 for 10 years. So we've got $25 going for all of eternity. So we need to subtract out $25 past that 10 years, but we also need to add in the $1,000. So we're going to receive $1,000, but we got to get rid of the $25 all of eternity. So in 10 years, we need to add the $1,000, and we need to subtract in 10 years the $25 for all of eternity. So we need to raise that. We need to discount that by 1 plus 0.015 divided by 2 raised to the 20th. Let's see if I get this right. I never know if I will. So if we add those two things together, it should give us exactly the present value of the bond, and it does. So if you think about this, let me bring it all in together so you can see it. This is exactly what that present value of an annuity formula is doing. So if you look at this formula, you take $25 divided by 1.05 divided by 2 plus $1,000 minus that exact same formula, minus 25 divided by 1.05 divided by 2, and you take that entire thing and divide it by 1 plus 0.015 divided by 2 raised to the 20th. If you do that, you will get exactly the price of the bond. So again, you don't have to do this on the exam, but boy, it's a really good formula to know, and it gives you a good shorthand. All right, so let's practice a corporate. We'll do this entire thing again. So that was a treasury. Now we're going to do a corporate bond. So we got a corporate bond, and let's say it is a 30-year, which is pretty rare, but a 30-year corporate bond issued 25 years ago. All right, and let's look at some treasury yields today, and let's look at some spreads today. Let's say this bond was rated AA 25 years ago and is rated BBB today. All right, let's look at some yields. We'll look at some 30-year yields, and we'll look at some 5-year yields and spreads. So I give you this on the exam, and you just have to know which numbers to pick. You'll see some exact, in fact, there's there are some YouTubes out there that do this exact same thing already. So let's say the 30-year yield on treasuries, let's say it's 3.5%, and let's say the 5-year yield is 2%. I know those numbers are both really low given what's going on right now, but let's just say that's the assumption. And let's say spreads for AA and BBB bonds, let's say for 30 years for AA is 75, for BBB is 350, and for 5 years, let's say it's 35 and 240. So if I give you all that information, then you have to figure out, okay, which numbers do I use? Do I use the 30-year treasury for my risk-free rate, or do I use the 5-year treasury for my risk-free rate? Do I use AA spreads, 30 years or 5 years, or BBB spreads? So for your purposes, I give you all this information. You have to know, forget 30 years. 30 years doesn't matter. At this point in time, this is a 5-year bond. A 30-year bond issued 25 years ago is a 5-year bond. So we can ignore all of this. We don't need that at all. So just ignore that. We're going to use, this is a 5-year bond. That's all that matters. So that tells us what our risk-free rate is. Let's say the coupon on this bond is, I don't know, 7%. Interest rates would have been a whole lot higher 25 years ago. Even though it was a AA rated bond, is 25 years ago. And which spread do we use? Well, it doesn't matter that the bond was rated AA 25 years ago. All you care is what is the bond rated today. So it is a BBB bond. So we're going to use a 2% risk-free rate and a 240 basis points spread. Now remember, basis points, you divide by 10,000. So 240 basis points, you take 240 basis points, divide by 10,000, and it gives you 0.024. So let's put our discount rate in there. So our discount rate is going to be the risk-free rate. The risk-free rate in this case is 2% because it's a 5-year bond. The spread on this bond is going to be 240 divided by 10,000. You always divide by 10,000. That's the definition of basis points. Spreads are given in basis points. And so my KD, my discount rate for this bond is 2% plus 2.4%. And then my effective yield, you remember the formula for that, I take 1 plus 4.5% divided by 2, raise it a second, minus 1. Let me move this over so we have a little bit more space. Alright, so there's my effective yield. You know the effective yield, like we did last class, is going to be a little bit higher than the discount rate, than the KD. So the effective yield is the actual discount rate we'll use. Let's do our guess on the price. So this is a 5-year bond. I'm going to guess that the duration is 4.5 years times, well, the discount rate is 0.044 now. It was 0.07. So my guess on this bond is that it's appreciated 11.7%. So you take $1,000 times 1 plus 0.117. And so our initial estimate is that this bond will be worth $1,117. The short formula, again, you don't have to use the guess all the short formula in the exam, but I'm going to go ahead and do it, is my coupon is going to be $1,000 times 7%, but since it's paid twice a year, I divide by 2, so my coupon is $35. So I'm going to, my short formula is I'm going to take $35 divided by 0.044 divided by 2. So you take the KD, don't use the effective yield here, use the KD because we're actually adjusting for that in our formula. Plus, I'm going to get $1,000, but I'm not going to get $35 forever, so I subtract that exact same thing out again. And I'm going to divide all of that by 1 plus 0.044 divided by 2 raised to the 10th because it's 5 years. And I get an estimate that's, I get a number. This is not an estimate. This should be the exact right number. I get a number that looks like it could definitely be correct because it's very close to my estimate. What you do have to do in the exam is this next part. So you have time, you have the cash flow, you have the discount factor, and you have the discounted cash flow. So here we have a 5-year bond, so we start off in 6 months, and we need to add 0.5 to that, and we want to go out 5 years. So there's our 5 years. My cash flow, I already know my cash flow is going to be $1,000 times my coupon divided by 2. You just have to know this. That's $35. And then I just equal that all the way down. I want $35 all the way down. But then in year 5, at the very end, you add your $1,000 back because you get your money back. My discount factor is going to be 1 divided by 1 plus my effective yield. You want to lock that in because you always want to reference that. So put the dollar signs around that, and you want to raise it to time. I recommend going out 4 decimal places. I'll put that formula off to the side so you can see it. Hopefully you're putting everything in the exact same cells that I'm doing. And you can copy that down. Then your discounted cash flow is you just multiply across $35 times that. And copy that down. And so my price, my actual price, is just going to be the sum of those discounted cash flows. And see, it came out exactly right. 115. My estimate is $1,117. My price actually is 1115.56. Let's figure out duration. Again, duration is you just take time times the discounted cash flow divided by the price of the bond. You have to lock that in. The reason I'm not hitting F4 to lock it in is because this computer actually doesn't do that for some reason. And so I get my weighted average time, and so my duration is just the sum of those weighted average times. My duration, remember I estimated 4.5. It actually came out at 4.35. All right, so there's an example of a bond. I'll put both of these spreadsheets. I'll put this spreadsheet, the Treasury and the corporate. I'll put them out there on Blackboard so you can see them. I'll save them so we can find them. But yeah, so that's how you do it. We'll practice this more, and we'll have a team question on this so you can get more practice. Hopefully you've seen this before. This is just a refresher. But if not, practice it, get good at it. It's a very important skill that every finance major should have, and really every business major.